Good morning,
Very good.
Carmen. Yeah.
Good morning. And, JK, it is a pleasure to see you again, albeit virtually this time. I have to say I have very fond memories of the event you hosted earlier last year. And without further ado, let me say a little bit of some of the issues and topics I'd like to cover. I hope to say a little bit about the general comparisons of the current crisis to the 2008-2009 global financial crisis. And I hope that the thrust of my conversation, though, will be more forward-looking in nature, and the areas where I think I'd like to focus on is more the prospects for trade, growth, globalization, and of course, some of the debt issues that are coming up with emerging markets as well in the current crisis. So by way of landscape of my remarks, that is basically where I'm heading. Let me begin by referring to the fact that I think I have to start out my remarks by congratulating the way that Korea has handled the crisis. It's really an example, a template for the rest of the countries. I have to say that when one looks at the speed, transparency, the public policy, it's really a template for an excellent response. What I'd like to do is start out with some of the general observations of, given my work on historical crises, of what resembles, if anything, the current environment. And the first, as you might expect, people think what people ask me is this time different? And I have to say, this is really different. This is truly different. I made that point actually in early March because, we've had pandemics for forever. However, what is very novel is the policy response, the large-scale lockdowns, and the impacts of the pandemic on economic activity, which is the focus of my talk, are unprecedented. And unprecedented is a term that gets used very loosely, but I truly think this is unprecedented territory. And the 1918 pandemic, which was, between the loss of between 50 and 100 million lives lost during that 1918-1920 period, is not really a relevant point of comparison for any of our discussion, because it was World War I, and actually in 1918, the United States had real GDP growth of 9%, the worst year of the pandemic. So it's really not a point of comparison that serves any use. What is very, I think, more insightful is how does this compare to 2008, 2009, which we lived through not that long ago, and to some other episodes that, particularly the Great Depression, where I think more parallels emerge. Let me say that what may be perhaps the most obvious, this is a lot worse than 2008, 2009. This did not start out as a financial crisis, but it has morphed into a financial crisis, an economic crisis. And in that regard, all the work that I have done on the aftermath of financial crisis, I think starts coming into play in ways that help understand what may lie ahead. And let me start the comparison of why I think 2008, 2009 is not the path, and some elements of 1930 are more worrisome as the comparison. First of all, this is a truly global crisis. 2008, 2009, it was 11 countries, mostly in Europe and the United States, that had a housing-led financial bubble that led to a banking crisis. At that time, countries like Korea, countries like the Nordics, were countries like Canada, Australia, New Zealand. So you had a core of advanced economies that were all hit in late 2008, early 2009, but the recovery was swift and much more robust. Emerging markets and developing countries, which were being fueled by China's double-digit growth and very high commodity prices, also came out and had a V-shaped recovery in 2008, 2009. This time around, we do not have the China locomotive with, China's growth rate from 2003 to 2013 averaged over 10%. Commodity prices were extremely bolstered by that growth, which pulled along big parts of Latin America, big parts of sub-Saharan Africa, and in general, the commodity producers. This time, like the 1930s, the crisis is truly global. It in varying degrees. It affects both advanced and emerging, so it's not a surprise that the International Monetary Fund came out and said this is, the biggest drop in the post-war in terms of global growth. Since then, the World Bank has come out and said, well, it's looking even worse, with somewhere between 5.5% downturn, and so the global dimension is more akin to the 1930s, in which both advanced and emerging markets and developing countries were all involved. The second parallel I've already alluded to, which is the weakness in commodity prices. The third factor is that we have seen a major hit to trade, global trade. Now, to be very clear, the first hit to global trade was 2008, 2009. In the decade, and I spoke to this in our May meeting, the pre-crisis decade to 2008, 2009, the volume of trade growth, trade volume was about 6% a year on average for that decade. Since then, the last decade has been slightly less than half of that growth. And so we've since had the global financial crisis, we had Brexit, we had the US-China trade war, and now COVID. So the trade implosion associated with this crisis is starting out from a weaker base and much more disruptive to global supply chains. Absolute paralysis in the area of tourism and service trade. So the global hit, I have, as you know, from my work with Ken Rogoff on This Time is Different, singled out the trade implosion of the early 30s as something very unique since the global trade data is available, which actually goes back for almost 150 years, not quite, but the general point being the global nature, the weak commodities, the implosion in global trade are three elements that make this more akin to the 1930s. I will get to the differences very shortly. The other one is financial market volatility. which of course we saw in 2008, 2009, but the degree of volatility that we have seen since the beginning of the pandemic is surpassed the volatility of 2008, 2009. Now, obviously, the policy response in terms of monetary stimulus, fiscal stimulus, has been completely different from the 1930s. So that bodes well. But when I said earlier that my concern is that this crisis, which started and has its roots in a health problem, has morphed already into a financial problem, is that with output declines like what we are registering pretty much across the globe, the issue of insolvencies at the corporate level, insolvencies at the household level, and insolvencies at the sovereign level in the emerging market developing country space, make it very much like the worst of financial crises. And so looking forward, the idea that the recovery from this crisis is going to be vigorous or swift is not what I think one realistically can expect. And I think that we can, I'd be happy to discuss what my prospects on some of those issues are.
All right. Okay, thank you very much, Carmen, for a very enlightening speech, as usual. Perhaps for the next 5-10 minutes, we may talk about the kind of emerging issues that of interest of our audience. In that context, do you think a V-shaped recovery still a possibility, or is
So, that is, I think, the question of the day. The question that you're posing is a question of the day. I think that one distinction I'd like to make is let's not confuse rebound with recovery, okay? Because of the very sharp contraction, unprecedented in the US and in a long list of countries, we will see some spectacular numbers, assuming, of course, there is no second wave, or that we've seen the worst, at least in Asia, in Europe, or parts of Asia, I should say, in Europe and in the US, assuming there is no second wave, which we can discuss. We're bound to see from these levels a very sharp pickup in activity, but is that really recovery? If one looks at per capita income, I think it will take 4, 5, 6 years to get to the level of per capita income we had before the crisis. So during that time, yes, we are going to see, I think, some, much better numbers on unemployment, much better numbers later on in indicators of business confidence and growth and so on. But to put the distinction of recovery in perspective, and going back and comparing to the 2008-2009 crisis, for the US, out of 2008-2009, it took 5 years to get back to the pre-crisis level of per capita income. For Europe, it took much longer. For Italy and for Greece, at the moment, their per capita level income is below what it was in 2007. And if you take the projections of with a grain of salt because of the level of uncertainty of the IMF, at least until recently, going into the outer years, neither Italy nor Greece will have as late as 2020s, 2024 per capita incomes that were at the pre-crisis level. So I think the optimism is, of course, the belief that the worst, most shocking numbers may be behind us. But that, and saying that that is recovery, I think we are in for a very bumpy patch. I track corporate ratings, I track sovereign ratings, I track the outlooks, and it's very worth noting that, let me start at the sovereign level and I'll work to the corporate level. If you look at Standard & Poor's, Fitch, Moody's, we are seeing in this year, and we see them on a daily basis, a record level of downgrades, which means these are balance sheet problems. And by the way, the record downgrades also apply at the corporate space. So what we have seen is, the cumulative toll. Yes, the flow may get better, but the balance sheet has been damaged. Now, there is certainly cause for optimism that just today, Chairman Powell was out there basically reassuring markets that rates are going to be low for very long. And we know also that the Fed's expanded facilities, which is, of course, other central banks, including Bank of Korea, have been providing support to the corporate sector to weather this out of league downturn. But it is hard to see a drop in incomes that is this severe, that doesn't imperil. We know we know that public sector balance sheets are going to be overstretched. The U.S. Will have record debt. A long list of countries will have record public debts. But I think of a more worrisome immediate area of concern is that while a great deal of support is being provided at the corporate level with all the Federal Reserve facilities and similar facilities across the globe, that still leaves household balance sheets very vulnerable. And let me add on that note, I am still very concerned about the fragility of the financial system globally.
Okay, thank you. Perhaps we may talk a little bit about bigger picture. By that I mean, we often talk about new normal in the post-COVID era. What are the big changes in the structure of the global economy, the financial system, or even international order? So, any perspective on?
So, on that very big picture, I think I am very concerned about the demise, if you will, of globalization as we knew it, especially globalization as we knew it even before the global financial crisis. If you look, whether you look at global trade, when you look at global finance. Globalization, as we knew it, even pre-2008, let alone pre-COVID, globalization goes through long cycles. We think that we lived through the first era of globalization, but that really was not the first era of globalization. Without giving a history lesson, I'll be very succinct, but the late 19th century saw a boom in trade, saw a boom in cross-border capital flows. There was a very vibrant bond market, bond issuance, financial linkages. That first World War I, then the Great Depression, and then World War II, we ended up with Bretton Woods. And Bretton Woods was an era of capital controls, and it was an era where the renewed surge in trade happened, very gradually. And that process of global integration continued really uninterrupted and full speed ahead until about 2008, when the global financial crisis broke out. And as I've already noted when talking about trade, the era of globalization meant, a lot more interlinkages at the corporate side, a lot more interlinkages in terms of cross-border flows. Both of those indicators are poised to turn down, and not turn down just, I think, in response to the immediate shock, but there's the question of how quickly and to what level they will recover to. My concern with globalization is that, let me start on finance. At the level of finance, I think, I'm not expecting a return to Bretton Woods. I'm not expecting a return to broad-based capital controls, but I do think that, especially if we see a lot more turbulence in developing countries and in emerging markets, we will also see, a lot of the cross-border capital flows be severely impacted. The numbers that the Institute for International Finance publishes on capital flows have been nothing less than alarming. Let me provide some context there. I mean, in the worst week at the end of March and in early April, the collapse, there's no other way of describing it, in capital flows to emerging markets. The collapse in 6 weeks was something that took about 52 weeks, about a year, to actually play out in the 2008, 2009 crisis. So it was a lot more compressed. On the trade side, we have the World Trade Organization saying that in 2020, trade could collapse anywhere between 13% and 32%, which is, again, another marker that even if there is a great normalization, it's coming from a very weak base. Superimposed on this, there are geopolitical issues. Do we really think that the pre-COVID tensions between China and the US have subsided? Quite the contrary. So I think that this robust trade and finance network is not going to be restored in the post-COVID landscape. I think also that this crisis, this is very relevant, is a very regressive crisis. And it's very regressive in that lower income has, the lower income workers have been hit the hardest in terms of job losses. In the context of access to credit, the very small firms and businesses have been hit particularly hard. And what was in many countries a tense situation with regards inequality, I think, is being amplified. And issues of slower growth and inequality, going back to your question, have tended to be periods in which countries start looking more inward. A lot of the rise, if you look historically over the long haul, the rise of protectionism, which we saw in the 30s, and the rise of populism in many countries is often tied to two factors. One is the pie getting smaller and the distribution of the pie getting more unequal. And it's not an uplifting picture, but I do think those are very real risks, especially against a backdrop of very continued tensions between the two largest economies.
I'm sure our audience will be delighted to have your great speech this morning. Thank you very much, Carmen.
Thank you. Thank you. It's a pleasure.